ask myself internally probably once or twice a year, which is like, man, can stock volatility die? And what I mean by that is, what happens if the stock market only goes up? And, you have done a lot of work. You used to be on Tasty Trade's research team, and you've studied, derivatives, be it futures, obviously here at the Futures Exchange, but also options. And it becomes this conversation of like, the stock market seems to only go up. And if the stock market only goes up, then that means that puts should theoretically trade at zero, and thus volatility, which is a function of option prices, should go to zero and be dead as well. I mean, does this idea, it's theoretically possible, practically, I would say impossible. I don't like to throw that word around a lot, but there's probably a 0% chance volatility will ever go to zero. But does this trajectory of like stocks up, put prices down, volatility near zero, does that ever enter your brain? And do you ever take it to the kind of the farthest end?
Oh, I mean, I never go like existential with it, but I mean, if you look at S&P just grinding higher since like 2009, that was a brutal period for option sellers. I think a lot of us can relate to that. Volatility just wasn't there, but it's also this phenomena where it comes into play at the most random times. And if you look at a historical chart of VIX, even going back the last 2 years, like we've seen highs of 41, we've seen spikes up to 37. And granted, those spikes are getting lower and lower through time, but I don't think it's something that's ever completely removed from the market. And there's actually some funny commentator, like professional economist commentation on this, when everyone thought they had banished volatility. They thought they had banished volatility leading into 2008. They would never see it again because of the amazing financial engineering of Goldman Sachs and everyone else. Obviously, that wasn't the case. And I would say that it's not the case today, though it's tough to watch the S&Ps just continue to grind higher and VIX sit below that long-term average. But I think at some point it always comes back.
Yeah, and it's interesting that yesterday actually was the 55th new high in the S&P 500 on this year, and that it's funny because I was doing some research for next week's newsletter going to community members. If you're not already a community member, you get a bunch of exclusive data and commentary and merch and exclusively low fees. All your fees and small exchange products cut in half. Community.thesmallexchange.com. If you're not a part of our crew yet, go join up this weekend. Maybe you got paid here today on Friday. Go get that community membership for life. But I was crunching some numbers because a lot of this happens around now every year, which is like, man, we've seen a lot of new highs in the stock market. And just go back for 1 second. Obviously, look at this thing. There's a lot of highs here. I just told you yesterday was the 55th of the year. And I'm doing some research, Mikey, and I'm looking back the last 5 years. And the last 5 years, there's an average of like 30 new highs every year. And in 2000, I think it was 17, there was 54 new highs in that year. And so it's all to say that like, this is still relatively normal. And though Frank gets in his own head here sometimes and is like, wow, if we continue on this trend, then option prices go to zero, volatility goes to 0%, and price action becomes completely predictable. And there's no trading. Like if that is the scenario, then the trade is buy, hold, and do absolutely nothing else into perpetuity. But I'm glad that you bring up that idea of like what was happening in 2008, because I would contend it's the same thing that happened in 99. And I actually, this is what I put in the newsletter, is a bunch of research around the stretch of 95 to 99 going up to the crash of 2000 and 2001, where we as a society and our financial market as a market, there always reaches this point where it's like, you know what, I think risk actually is out of the market. Like, I think they actually solved it and there's no more risk. And inevitably, risk does enter that market again, because it's not the first time we've seen this trend. And it's not the first time. I'm glad that you brought up that idea occurring in 2008, right? Like this happens every few years.
Yeah, it's really easy to talk yourself into this situation where it almost feels like equities now are the risk-free trade. And it's like all this money has flown in, just like bonds were a risk-free trade for a while, given the credit quality of the US. But, You have to be careful. I don't think you can let yourself slip into that position.
Sure.
And one argument you could contend is that it's better to do something than to do nothing. Like if you think stocks are this risk-free asset class and there's no short trade, there's no short premium trade, I think you're actually wrong. I think it's much better to be engaged in the market and do something rather than sit on the sidelines trying to forecast or wait for volatility to come back into the market. You can still be proactive even with S&Ps breaking all-time highs 55 times in a single year.
You're absolutely right. And it's funny, we're talking about stocks today, but I was talking with Liz and Jenny yesterday. They were long interest rate products from the small exchange. And they were long a few of them. And they were also selling strangles and iron condors in other interest rate products around their long position. And those interest rates moved lower since they had bought them last week, but they had made back more than half of the losses in selling those options around it. And now you look at today, interest rates are up huge. That position is probably up for them, the long position. And in the meantime, they had mitigated more than half of those losses. So now they have, thank you, shout out to viewer Bianca, who actually emailed me, that's icing on the cake. And that's the colloquialism I was trying to get there. And so it is, I think, better to do something than to do nothing, because volatility isn't going to die, and we're not going to continue. Like, even we were at this point in 2020 when a pandemic came out of nowhere. And what we've seen is really interesting, because you look at the rate of change from 16 to the start of 20, and it's upward sloping, and it's a pretty consistent upward slope there from 2000 to 3000. But then what's really interesting and really gives me pause as a holder of a pretty hefty long stock position, and 401k and otherwise, is the fact that you've got this rate of change over 5 years of about 1,000 points in the S&P, and then you've got a rate of change in about a year and a half from the start of 2020 until now that is 2,500 points in a fraction of the time. And that's something that really, especially like we say, when people are jumping on Twitter and jumping online to say, I think they solved it, like the risk is gone. That's when you tend to get these moments, because look at I crunched a bunch of numbers, like I said, but I also wanted to put up this chart. This looks scarily similar, right? Like 95 until 2000, getting right up until that .com crash. It looks exactly the same. I'm sure a lot of comments going past people in a different medium. I'm guessing maybe MySpace was more relevant. I don't actually even know if MySpace was around back then. Twitter definitely wasn't. But it's the same kind of idea, and this is likely not to be the last time that this passes, and likely not to be the last time that we saw a crash, being that 08, 09. We're probably due for one. I don't know when it is. And I don't know if I think a lot of people would say, like, oh, it's going to be these NFTs and cryptos, and like, who knows? Like, who really knows? Like, we had that pandemic last year still ongoing, but the bulk of the downside we saw in equities from that pandemic actually hit not those technology stocks. Those outperformed those ones that had seen the most upside. It was energy stocks and some of those other ones that had seen more downside. So who knows what it's going to be, but it's likely not to be the last crash there in 08, 09, or back in 2000, right?
Yeah, absolutely. And I love and I appreciate this, because so many people are scared to say that they don't know. They try and forecast this next crash. They say it's coming soon. These are the fundamentals to support it. I don't think that's what we're trying to say here. I'm not speaking for you, but it's not what I'm trying to say. We're just saying it does happen this way sometimes. And the best thing you can do to prepare for that situation, because volatility has not completely vanished from the market, I'll say it, is just be active and be engaged and stay tuned with what's going on. Liz and Jenny presented a perfect example there with a core long position in rates, trading against that with some short option positions in related products. And I think that's really all you can do, is be active and be engaged to protect against those potential downsides.
And I'll give you here, to close the segment, probably the easiest way to the first step in getting active with like a long stock portfolio that is likely due for some kind of downside in the next year to couple of years is using some short equity futures. Now, the problem with the S&P 500 futures, oftentimes those E-minis, Michael, are well over $200,000 now. And so that means that for me to sell one of those futures and hedge my portfolio, I better have a portfolio of stocks larger than $225,000. That's a lot. And even if I have that much, that's one unit hedging 100%. You usually want to just, and it's funny, we talked about all-time highs. Every time you see maybe 5, 10, 20 new all-time highs, maybe you toss out one little hedge in there. And what's nice is that the small stocks futures at just around $7,000 in value, you can have a portfolio of just 10, 20, 30, 50 grand of stocks that you've accumulated in 401ks or just IRA or whatever investment type there. And every time you see a dozen or so new all-time highs, you toss one out there. And then also if you see some downside, that's not a full-on crash, but I forget all the words that they have for the different
downturn, correction.
That's another one where it's like, if it's 10%, it's correction. If it's 25%, it's crash. Who the hell cares? But you can lay those out there, sprinkle them out every few all-time highs, and then buy them back, not necessarily anticipating a crash or volatility returning to, 50, 60, 80 levels like we've seen in the past, but just a little bit of back and forth that I think we're due for, given all of the upside we've seen in the stock market. So can stock volatility die, Michael? No, I think we'd have to be in some kind of futuristic, fully utopian environment if the stock market literally is just like you showed up every morning and stocks are up 0.5% or a full percent. And that is absolutely it. So volatility will always be there. Best to be a little active and prepare for it with some small hedges from time to time. Got anything else? That's it.
No, I agree with you completely. If stocks just consistently returned guaranteed value, then it would just become inflation. So it wouldn't even exist. But that is a different thing for a different day. So tune in the next 5 years. We'll talk about that.
Yeah, absolutely, man. I'm so appreciative to have you on here Friday afternoon. I know you're just staring out there at the pizzas and ready to pounce on, what do we have today? Mushroom and onion pizza. And then the meat eaters have the sausage and pepperoni and no vegetables. That was the one requirement from.
It was just no vegetables.
Yeah, absolutely. Not only do we want meat, but we absolutely want no veggies, which I can appreciate. I appreciate more than the people. Do you know these type of people, Mikey, who like get a pizza for dinner and then if they put like green peppers on it, it's like, oh, there's at least like some healthy stuff into this. And it's like, no, like it's not going to be healthy no matter what you put on it.
Yeah,
like you could put arugula on it. It's not healthy, dude.
I had a friend come to visit Chicago one time and we did a pizza tour of Chicago. We just thought it was something fun to do. And I was the only one who was vegetarian on this pizza tour. They like provided us a shuttle bus and there were like 20 people on this tour. We went to a bunch of pizza locations. And of course the guy asked, does anyone have dietary restrictions? I'm like, yes, I eat vegetables, stuff like that. So he got me vegetable pizzas where we went when it was applicable. And I offered other folks at the table, hey, do you want to try some of this? It's really good. After they had finished theirs, they were out. People just straight up told me, no, I don't eat vegetables. Like I only eat vegetables if my significant other like tricks me into eating vegetables.
What kind of way to live is that? Like it's absolutely like you and I have had meat, and like if we go to like a nice restaurant where like the like meat is really like an important thing, it's like, yeah, I'll try it. Like I'm not like not going crazy, but yeah, the people who are like, I'm so into meat that screw you and your vegetables. It's like, it's on the menu because it's good. Like it's not on the menu and it's going to be bad. Just, I don't know what to say to those people. Just try. Hey, everybody this long weekend, try something new. If it's veggie oriented pizza, then go for it and try something new. But Mikey, I'm going to let you go try some of that pizza. I'll be joining you in just a little bit. We've got Splash into Futures coming up next. Friday afternoon, markets are in some interesting positions, so we'll get some interesting trades on for what'll hopefully be an interesting long weekend. Thanks as always, Mikey. Thanks for watching, everybody. Peace.